Hi, this is David Skrika of Addicted to Profits and Stock Chart of the Day, and soon to be Dollar Collapse, a new venture I'm working with. And today I have Brett Richards. He is now, I guess, the co-CEO or interim CEO of Goldshore. He can tell us why that's happening. And Goldshore is a company we've talked about in the past. They've actually had some good news as of late, but right now it's the old tree falling in the forest. No one really cares in this gold market. And we've seen some of the major companies like B2 Gold and Newmont actually do very, very poorly on their earnings. So it's a horrible market. I'm sure he's been around a lot longer than me. I've got actually a friend who now does consulting. He was a broker. He's 70 years old. He's been doing this for almost 50 years. He told me it's the worst market he's ever seen, like even worse than the early 80s, even worse than 2008, etc. So if you want to elaborate on that, and then we can get to more positive things with the company. I think it is going to turn around. I've talked about this in my videos, but tell us a bit about yourself. You've been on before, but and the company, the projects, and why we think this will finally turn around.
Yeah, Dave, thanks for having me on again. It is, hey, I've been around this game for a long time, 37 years to be exact. And I've run a number of mining companies in my career, as well as steel in the early days. But, I would agree with your sentiment of your friend. I have never seen a market this bad in my life. And when you look at the early 80s, when you saw hyperinflation, and, I remember getting one of my first mortgages at 18%, and that's just craziness. But that's kind of where we were. This market isn't that bad. The macro dynamics are really contrarian to kind of historic economic cycles. We now have a situation where the gold price is actually propped up, and I think we've seen the floor, and inflation has kind of tapered off to 4%, and interest rates are kind of trajectory wise coming down. That really, again, bodes well for money coming into our sector and money flowing into gold. So yeah, I'm actually pretty excited about the next 18 to 24 months, because I think we're going to see one of the biggest bull runs in history in precious metals.
Yeah, and I've talked about this in past videos that when you're early on in a rate cut cycle, precious metals and precious metal companies, stocks, equities tend to be actually not only outperform the S&P, but they tend to be the best performing sector, because a lot of the money that moves early on in those rate cut cycles, we were talking about this off air, is not speculative money. It's money that was in interest bearing instruments. And they're like, well, people that are in those type of instruments aren't going to dive into, AI. They're going to look at something that's a little more conservative. And I think that money will somewhat move into precious metals, because as they're getting less interest on an interest-bearing deposit or the whatnot, they're going to look at something that's still kind of secure, but also benefits from the kind of loosening cycle. And I'm telling you, if you go back to bull market cycles like 95 or 2019, or bear market cycles like 01, 02, the gold and precious metal equities are about the best performing equities in the early stages of a loosening cycle. So
yeah, and very true. I think we're going to see, probably in the next 12 months, we're going to see $3.5 trillion need to be repositioned in asset classes that are no longer fixed income. And let's face it, they went there for yield. They went there for, because of the rate hikes. And that money now is, I'm not going to say risk on, but it's quasi a little bit risk on, but they're also looking for yield. How do I replace that yield? How do I not take too much risk? And how do we protect the downside? Let's face it, I think what's different in this cycle we're going in is we have a very chaotic geopolitical situation.
yep.
That is driving the macroeconomic situation, and a US election which is, in my view, completely chaotic. So all of that chaos and that noise, I think, bodes very well for somebody to for cash and to flow into gold as a safe haven, to flow into gold equities as leverage to that safe haven, because of the chaos that's around us.
And that U.S. election, like I don't want to, I don't talk too much, politics on my podcasts or streams, but It is interesting because, yeah, you have two candidates, regardless of who you support, that aren't very popular. And I think the polls have shown nearly 70% of the electorate doesn't want either of them running. And you're probably going to have a third candidate in Kennedy who's going to get the most votes as a third party candidate since Ross Perot, right? So you're right. You do have this very chaotic election. And, the deficit is estimated to be $3 trillion a year, more than 10% of GDP. And like at the top, in an economic, expansion, usually you get those kind of deficits, at the bottom of the economy when you're in a recession. So that's another factor to look at as well. And I think that's a long-term, I'm sure you agree, secular factor that with the U.S. debt and debt of most Western countries soaring, and the U.S. debt's, I think, now north of 120% of GDP. These also make gold more attractive because it's a little different than other cycles. Because one reason those rates could go to 18% in the early 80s, as U.S. debt back then was only about 30% of GDP. So 18% now, and the U.S. government would be bankrupt. So that's another factor, is that they can't, the powers that be almost can't afford for rates to go much higher. This is about this 5.5% is about the top, I would say, with the current debt loads.
And I think we're going to see it come down to 4, maybe in slightly sub 4, but I think 4% is going to be the number. And let's face it, we're going to see weakening of the U.S. dollar to other currencies, not immediately, but over time. After, let's face it, running a $2 trillion deficit every year, they're talking about $40 trillion at the end of the next term of the election, next 4 years. Who's going to buy that? And we're going to see the U.S. dollar completely pull back. And again, good for gold, the perfect storm for gold. And that's why you have people saying that gold can go to $3,000. And there's people who say that'll go beyond. Because
here's an interesting note about U.S. debt, and this is kind of the double-edged sword of being the reserve currency, is that I think something like 7 trillion of the debt is owned by foreigners, right? Total. So, you got that's roughly a quarter of it, 20 to 25%. Well, like most Canadian debt is owned domestically, right? Most Euro debt is owned domestically. One reason Japan's had this high debt load for decades and been able to sustain it, it's owned domestically. But foreigners will tend to pull that debt quicker, if things get out of control. And that's the benefit of being the reserve currencies. You get that money flowing in, but the double-edged sword is if you get too fiscally irresponsible, that money will flow out. So that's an interesting note too. And I think at some point, we're now really seeing the emerging world, India, Indonesia, China has kind of slowed, but these countries are now seeing more sustainable growth that is sustainably higher than us in the West. And I think at some point you're going to see like just this trade where the Brazilian real or rupee are always consistently devaluing. That's going to end at some point, in my opinion. That you're talking about the devaluation of the U.S. dollar. It just won't be the U.S. dollar index, which trades against other countries that have the similar problems like Canada or the Euro or the UK. But you're going to see like the emerging world, and they're going to do some kind of BRICS currency. And I think that could at some point start to appreciate against the U.S. dollar.
Mm-hmm. Yeah, I think you're right. And hey, we've all heard about the USDD, the digital dollar that's going to potentially, throw some more chaos into it. I just think that the U.S., whether the Republicans get in or the Democrats get in, and let's be agnostic on that side of the political forum.
Yeah,
both of them are going to spend 25% more than their revenue, and that has been a historic problem. It's going to continue to be because the problems they have before them, have to have immediate spending to fix them, whether that's infrastructure or whether that's other domestic issues. The problem is they need a 10-year strategy, and they only have a 4-year election cycle. Sometimes you get 8, but you can't fix $40 trillion in 4 years. You might fix it over a decade, and the U.S. is after this run we're going to see. You're right. I think we're going to probably go into a bit of a recession.
Yeah, and another aspect before we get into the company, talk about those macro terms. You're talking about the debt. I think that's the one problematic thing going on in the U.S. where like if you look at what's going to happen in the Canadian election, when probably the Conservatives are going to win, the Conservatives have a history, the recent Conservative Party, at least, under Harper, and probably the same thing will happen under Pulver, is that they're fiscally responsible. Like they were running balanced budgets under Harper. And I think you'll see that under Pulver, where I think the issue in the US is it doesn't matter if it's Republicans or Democrats, they're going to run huge deficits. There's not like, there's no different. It's almost like, Greece before their crisis, that it didn't matter if the Socialist Party in Greece won or the Conservative Party in Greece won. They were both spending, like drunken sailors. So I think that's another issue with the US is that, like, do I really care if Trump wins or Biden wins? I'm like, no, like you're saying, I think there's going to be like another minimum, 8 to 10 trillion in debt piled up over the next 4 years, no matter who wins.
Yeah, I think that's right. So you're right on the money with Canada. I think you're right. The Conservatives are going to, they're going to wake up in power, and they're going to realize how bad things really are. Not just how bad we think they are, but how bad they really are. And this is going to be a real test for the leadership of the Conservative Party to be able to run a balanced budget and get this thing back under control. Because we can't, in Canada, they certainly can't, take the same fiscal irresponsibility as the U.S. And otherwise, the impact on Canada is compounded to what it is in the U.S. They just simply don't have the critical mass as the U.S. has.
Yeah, like if there is another spike in inflation, which I expect in a couple of years, Canada's going to import some of that because it's right next to the U.S. It's its biggest trading partner. It's dependent on the U.S. economy, but it can buffer it a bit if it has some fiscal kind of responsibility. And I think that's what happened in the financial crisis, because again, Harper ran the country somewhat fiscally responsible. So Canada wasn't hit as hard, during the Great Recession. So anyhow, just to get into now your company. So you were saying something very interesting offshore, or sorry, off camera, that, and I thought this was a good philosophy that you have, that many juniors sometimes need to take on if they're cashed up. It's the old, the squirrels, getting the nuts for like the winter, preparing for the winter or the whatnot, that, you kind of, these companies raise money and then usually go right through it. And then when a downturn happens and they have to raise money, it's really dilutive because the stock price has gone down a lot. But you were talking about kind of being in almost like a quiet period until you see, because you're cashed up, you do have things going on until you see the market turn around. Because right now, the company has results, good, bad, indifferent. It's just not going to respond to them. Well, respond to bad, but it won't respond to anything positive in this type of market. So if you can just elaborate on that, like, and I think that's a unique kind of approach. And I think I've seen companies take it in the past, and I think more companies should take it if they have cash that they can kind of, survive on for years.
Yeah, and I've said this my whole career. I'm not a guy that's going to sit on my hands, do nothing, take a paycheck, and watch the market go by. And I think we do see that sometimes, and in some of these companies, Goldshore, we've been at this now for almost 4 years, since June of 2021. We have a 1.5 million ounce in indicated resource at 1.23 grams, and we have 5.2 million ounces of inferred resource at 1.11 grams at the Moss Gold project. So globally, we have an extremely large resource. However, we can define a path to 10 or 15 million ounces. And now you're starting to talk about a tier 1 project. Okay. But what has happened? We put out news for the last 2-3 years. The geopolitical situation, the macroeconomic noise from last year and still going on, has taken resources and taken investors out of our sector, to the point where we put out good news and it's a liquidity event for people to sell into. And we've seen that right across the board. Goldshore today is trading at $4 an ounce. And that is crazy, because historical norms for inferred are around $20 to $25 an ounce, and historical norms for indicated are around $40 to $60 an ounce. And that would indicate on historical norms that Goldshore should be trading at a $190 million market cap, when today we're trading at a $26 million market cap. So completely disconnected from historic norms. And it's not just us. It is the majors, it is the mid tiers, it is the juniors, the developers, the explorers. Everything is disconnected, and there just simply is no new investment, no new money coming into our sector. So I think a lot of projects are going to struggle. We were fortunate enough to partner with a group of guys out in Calgary called SAF Group, and the principals came into the last financing, and they have said, as a partnership, we want to bring SAF into this company in time. Now, we're not going to be raising money. We have $4 million in the bank. And I stepped down to be the interim CEO for two reasons. First of all, I don't think it's appropriate to be drawing a salary when any degree of advertising and letter writing and conference attending and speaking engagements, I'm speaking to the same people. If you are reaching a new audience, and this is why we're together today, and I love this forum, but it just, nothing is moving. Nobody cares, and I don't see it moving anytime soon. So I have stepped back so we can save the cash, and we've got a lot of activities going on the ground. We got met test work. We're doing a number of hydrology studies. We're doing environmental baseline work. Lots of work going on because we have about $1.5 million to spend this year and flow through that we have to spend. But we still have $2.5 million in the bank, and we got 24 or 30 months of runway here to ride this out. And I think the best thing is to be patient. You don't need to force M&A when your paper's so bad. Yes, bad paper plus bad paper can equal good deal, but you're still left with two problems, not one. So let's just be patient. Let's wait for this market to come to us, and then we will take some strategic decisions on how we move forward when we're able to actually drill and put inventory on our statement that we actually get a return for. Trading at $4 costs us $10 or $15 to find them, depending on the season. 10 in the summer, 15 in the winter. Why would I go spend that money today and only get a $4 return? So I can't do it. And I think it's prudent that some of these companies just be patient. And I think CEOs should step back and say, hey, you know what? I'm not going to burn the coffers of shareholders. I'm not as busy as I once was. And they should relieve, they should be able to relieve themselves. Now, I have joined another company called Radisson Mining Resources, high-grade gold in Quebec, million ounces. RDS is the ticker symbol. And the reason I've joined them is because I can help them. They have cash, and they are moving through the development curve while we're in this slow period. So RDS is actually, they're not in a situation where they need to pause. Goldshore needs to pause. RDS actually needs to continue to proceed. And I think this is why they have held, their share price for some time. This is why people love them, is because it's got high grade. It's in Abitibi. It's the old O'Brien mine, O'Brien East and West. And it is, I think it's a great project. So I'm going to go help them, and I'm going to go help them get further down the field of development. And yes, I'm still going to stay on as a director of Goldshore. I'm still going to help Pete Flindell, who's the VP of X. But I just think the corporate activities need to pause. And we're going to be looking at those same corporate activities pausing for RDS. You just don't deliver a return today.
Yeah, because like you said, the sentiment I see is the same thing. Even if the news is pretty good, people will just use that as, maybe that will drum up some volume and they'll sell into it. And the one reason you were talking about being patient, I put up this chart of the GDX, so like the major gold stocks, but I just wanted to show people, because I think we're in a similar scenario that we were in 2018, 2019, when the Fed paused and then they began to cut rates in 2019. And what occurred was there was this, they didn't cut rates right away. They didn't stop raising them. I think it was October was the last rate hike in 2018, and start cutting them in December. They started cutting them actually in June. And it looks like now they're going to start cutting them in June again. And you could see there was this pullback in June of 2019 in the gold stocks. They basically were doing nothing. And then they took off again when the rate cuts, basically they cut rates to zero after COVID started. And you can see so I like you're talking about doing nothing. I don't think it's a long period of time. It's like a year, but I think at least you're talking 3-4 months till those rate cuts start. You should just, if you want, as an investor, stocks are getting cheap, so you can pick away a bit. But in terms of like actually being super active as a company, I agree with you. The next 3-4 months is probably not the time to do it,
Yeah. And you're right. The catalyst is going to be rate cuts. And I think the motivation is going to be rate cuts in a period of chaotic political climate as we approach the U.S. election. People want to be safe. A lot of investors I talk to, high net worth, ultra high net worth, who are very exposed in the market, are very concerned about a correction, a large correction based on kind of the outcome of the election or pre-election. There's a lot of difficulty, a lot of stress in that market. And hey, the GDX, I think, has hit another floor, and we're going to see that uptick cycle when rate cuts start again. So I think you've hit it right on the park. This is exactly what we've expected and exactly where we're going to go. I think we're going to trend up at least 20 points between now and the next 12 months.
Yeah, and another thing I've talked about with kind of gold, if you look at the last couple, like again, I talked about 2019. So this is the GLD. It's not gold itself, but that was about 1,400 on gold.
Yeah.
And the last two times we had these kind of resistance levels, which were 1,000 back in 08, 09, and then 1,400 in 18, 19. So in 08, 09, we went to 1,900, ultimately 2011.
But it pulled back.
And then we went to 2,100. So those were roughly 90 and 50% moves above the previous high. So if you use this high at 2,100, I think we're talking 3,000 to roughly 4,000 gold, 12, 24 months out. Like that's kind of my price target. And if you get also, as you know, the leverage in the gold stocks, the fact that they've kind of overshot to the downside means you have more leverage to the upside, because not only will they have to make up for the fact that they overshot, but then at some point, at the top of a cycle, you become overvalued, right?
Yeah. Right.
So that's basically my theory in a nutshell, is that, once we break this resistance, and again, if you look at the chart, it's very similar to the 2016 to 2019 period, where you had this resistance, you kept selling off it. But once you broke that resistance, and the longer that resistance hold up, usually the larger the breakout is, right?
Yeah,
so,
that's exactly right. Yeah. And I don't think many CEOs would be talking $3,000 gold 12 months ago, maybe 24 months ago.
Yeah.
And I honestly, I knew the fundamentals were setting up for a large, a peak in the gold price. But I am now starting to talk about $3,000 gold. I hear your point. Now you've seen the trend go up 50% before, and that's why you said $3,000 to $4,000. It's tough to imagine, but now the fundamentals support it. And like almost every major gold project that is in the pipeline today would be economic at those numbers. Here's the kicker. What happens to oil? Because if oil trends up during this period, you're going to see margin squeeze. You see margin squeeze on gold companies, because anywhere from 25 to 40% of their actual variable costs are going to be fuel. And if oil goes to 150, you're going to see all-in sustaining costs at $2,500 on a $3,000, $3,200 gold.
So right now, oil actually has some oversupply in the market, but I don't know if you do anything. But seasonally, December tends to be the low in oil, and it was again. And it looks like you may have support at 65 to 70. And another underpinning in oil is that, Biden sold off a lot of the strategic oil reserve. I think no matter who wins the election, that will be replenished after the election. So, because both these guys won't run again. So there's no political reason. So they'll replenish that. So that kind of adds a buffer of, support under the market. And I don't want to get into this part of it, but a lot of these EVs are now turning out just to be like Rivian had terrible earnings, and we're not seeing that boom like people thought we would, right? And and I think you're going to see that kind of support it too, as well. So like anyhow, the funny aspect of that is, you've done this a long time. I said, once the Vancouver promoters all turned their precious metal deals into lithium deals, that was kind of the top.
That's a sign, I know. Hey, don't worry, they'll be flipping them to nickel soon, and because
I already seen some going into uranium. So,
Sure. Yeah.
Anyway, I'd just like to end off here. That's about, I like these, to be roughly 20 minutes or so. So yeah, if you just want to end off, like I said, I think your whole strategy is very sound right now. And I know people don't want to kind of hear to kind of slow things down, but in this kind of market, I just think that's prudent. It's because right now you're banging your head against the wall.
You
Yeah,
are, and there's nothing you can do to add, sustainable value. However much you drill, however much you spend, it just isn't there. So why do it? And I've said before, and it's kind of a saying that I've been quoted on. Patience is a virtue, but
yeah.
I'm getting really sick of having it. You know what? You have to have patience. I'm sick of it, but you have to have patience in this market, because if you can destroy value very quickly, and some of these companies can go into distress, and once you're in that, it's very difficult to get out. Why? You don't have access to capital. Now you're running on nothing. You're running on fumes, and the CEOs have to finance them if they have the ability to do it. I've been there. It's not fun, and quite frankly, it is it's that environment. Be prudent. um, there will be our day. The day will be coming, and just make sure that you have enough powder in the keg to be able to blast off when it does come, because it's going to come strong and hard and fast. Yes, it is going to be when rates start to get cut. And I think people see a one-term election, either party, it's only one term. The structural problems the US have require 2 or 3 terms, but they're looking at this very, very short termly. So I really think this is the perfect storm for gold, geopolitically, macroeconomically, but also on the supply side. You have central banks buying like they have never
Yeah,
before.
there's another aspect. And
Yes.
I don't know if you saw recently, I'll just enough in this note, like Frank Justra recently was like almost begging, pension plans and the government. I don't know if I
Sure.
put the government in, but
No, you should. The future pension plan, OMERS, et cetera, all these big endowments and pension plans. Yes, they have a diverse portfolio, but we need to start funding junior mining companies, because Canada, we are a resource country, and we have 1,460 stocks on the TSX that are natural resources stocks, and they need to support the best of the best, and then they need to support others during this time. I think it's prudent.
and,
Invest in.
and even I'm not a fan of ESG or a lot of the green movement, but you need these metals for that. It's not just lithium. You need
No,
cobalt, copper, all that stuff for steel to be part of a windmill or solar panel. Like you need all of that,
absolutely. And the only way you can, there's no shortcut to finding it, blasting it, drilling it, digging it up, processing it, separating it, liberating it, and electrowinning it. There's no shortcut. You can't take it out of the ground and turn it into gold. You can't take it out of the ground and turn it into copper. We have a process we've done for hundreds of years. It doesn't change much. It gets more efficient, but we still have to do it. So people, yes, there is a green movement, and people don't always like what we do in mining. But the reality is, you want to use that cell phone, you want to use that computer, you want to use that electric car, it starts with mining.
Exactly. I think that's a perfect note to end on. Thank you.
Great. Thanks, Dave. I appreciate the time.
Thanks.